It's the first question, the big question, that every single investor asks. You're looking at something, anything, and you're just trying to figure out, is this a bargain, or am I about to overpay? Well, answering that question is exactly what fundamental analysis is all about. So in this explainer, we're going to treat fundamental analysis like a navigation system for the market. We'll look at the classic, timeless principles. Think of those as your compass. And then we'll get into the modern tools that work like a GPS, helping you find your way through the crazy, complex financial world we live in today.
All right, here's our game plan. First, we'll nail down what fundamental analysis actually is. Then, we're going to peek inside the company's finances. After that, we'll zoom out to check on the economic weather. We'll also see how the daily news can rock the boat. And finally, we'll look at the toolkit the modern analyst just can't live without.
So, what is fundamental analysis? Well, when you boil it all down, it's really a search. It's the hunt for an asset's real underlying value. It's true north, completely separate from the daily market chatter and all the hype.
One of the easiest ways to get what fundamental analysis is all about is to see what it isn't. The other big school of thought is technical analysis. Those folks are looking at charts, at price patterns, trying to guess where the price is going to go next, usually pretty short term. But fundamental analysis, it completely ignores the charts and asks a totally different question. What is this company actually worth? It's a long-term game, and it's all about substance.
And that leads us to the holy grail of fundamental analysis, intrinsic value. This is the price that's supposed to be based on, cold hard facts, things like earnings, debt, the health of the economy. So the whole idea is, if the market's price is below that intrinsic value, an analyst might see a bargain. And if it's way above, well, that could be a sign that it's overvalued.
Okay, but finding that value, it's not quite that simple. You've really got to look at things through two different lenses. First, there's the microeconomic lens, which is all about the company itself. But then you have the macroeconomic lens, which looks at the whole economy. And you need both, because you can have an amazing company that still gets into trouble if the entire economy is sinking.
All right, so let's start with that first lens, the micro level. We're going to pop the hood on a company's finances and see what's really going on in there. See if that engine is actually running smoothly.
Okay, so every single public company tells its financial story through three main documents. Think of them like the three pillars holding everything up. First, the balance sheet. That's a snapshot in time. Here's what we own, and here's what we owe. Then there's the income statement, which is more like a movie of how the company did over a few months or a year, showing its profits and losses. And finally, the cash flow statement. This one is so critical because it tracks the actual cash moving in and out. Now, analysts have these handy little tools called financial ratios to, quickly check a company's health. The P ratio, for example, is just asking, hey, is this stock pricey compared to what it's earning? Return on equity tells you how good the management team is at turning investors' money into profits. And the debt-to-equity ratio, that's a super important stress test to see if the company's taking on way too much debt.
There's a line from our source material that just nails it. The idea is that these numbers, they aren't just numbers. They're like the financial DNA of a business. They show you its strengths, its weaknesses, and its true character.
Okay, so we've looked under the hood of the company. Now it's time to zoom out, way out, and look at the whole economic landscape. You can think of this as checking the weather forecast before you decide to set sail. You want to know, is the tide rising with you, or are you sailing right into a storm?
And these are kind of like the main dials on the economy's dashboard. GDP tells us if the economy as a whole is growing or shrinking. The inflation rate tells us if our cash is losing its buying power. And interest rates. Wow, those are probably the biggest lever of all, because they can either speed up the economy or slam on the brakes.
And this chart right here is a perfect example of why that bigger picture matters so much. Look at this. You've got a company with a great profit margin, 15%. That looks awesome on its own. But the national economy is actually shrinking. It just drives home that old saying, right? A rising tide lifts all boats, but a falling one, it can leave even the best-looking ships stuck in the mud.
All right, so we've got the company's health? Check. We've got the economy's health? Check. But then there's this other wild card in the mix. News. Every single day, headlines and data reports can send markets flying up or crashing down. The real trick is learning how to separate the important signals from all the distracting noise. Now, to really get how news moves markets, you have to understand this one core idea: pricing in. See, markets are always trying to look into the future. They don't just react to what happens, they react to how it compares to what they thought was going to happen. Because here's the secret: the market doesn't really react to the news itself, it reacts to the surprise.
Okay, let me walk you through a quick example so you can see what I mean. Imagine everyone's waiting for a big jobs report. The general expectation, the number that everyone agrees on, is for 50,000 new jobs. That number is already priced into the market.
And bam, the report drops. 100,000 new jobs. That's fantastic, right? Double what everyone expected. You'd think the market would just take off like a rocket.
But wait a second, the market doesn't rally. In fact, it starts to fall. What on earth is going on? Well, it turns out that even though the official forecast was 50,000, the real expectation, the whisper number floating around between big investors, was actually for something more like 120,000 jobs. So even though the headline number was good, it was a disappointment compared to the real whispered expectation. And that surprise is what actually moved the price.
So this all brings us to our final piece of the puzzle. We've seen how complicated this can all be. You've got your compass, those core principles we talked about, but in today's world, with all this information flying at you at the speed of light, you also need a GPS.
I mean, just think about everything an analyst is trying to juggle at once. You've got company financials, you've got economic data, central bank announcements, breaking news, market sentiment. Trying to process all of that in real time is, well, it's a huge task.
And that's where modern tools are just such a game changer. Platforms like TradeGlass, which was mentioned in our sources, are built to wrangle all this chaos. They do the grunt work, pulling in all that data from everywhere, crunching the numbers, and laying it all out for you, turning that flood of information into something clear that you can actually use. But here's a really important point. These tools aren't here to replace the human analyst. Not at all. It's actually the opposite. By taking care of all the heavy data lifting, they free up the analyst to do what people do best: interpret the data, come up with a strategy, and make that final judgment call. They enhance expertise, they don't replace it.
So that brings us full circle. We started with a simple question, but now you've got a whole new framework for how to answer it. You have the compass, and now you know all about the GPS. So the final question really isn't for me, it's for you. Now that you know what to look for, how are you going to separate that real intrinsic value from all the market's noise?